What the heck is going on with China's Evergrande, one of the largest and most indebted real estate developers in the entire world? And what does it mean for China's $60 trillion economy and, quite frankly, our economy? Well, first, to catch you up, real estate wealth building in China has always been very important to not only the Chinese Communist Party, but also people in China. In fact, 78% of household net worth comes from real estate in China. In fact, the Chinese property market is expected to make up over 25% of the Chinese economy. Both of those figures about twice the figure that we have in the United States. So real estate's very important in China, even despite the fact that private land ownership isn't even allowed. Instead, real estate purchasers usually accept 70-year leases. But what's remarkable is that while China encouraged the taking on of debt via developers essentially financing their operations with more debt than they have cash or like assets, China decided, you know what, we're going to institute 3 red lines. China's 3 red line policy was really interesting because really China had been encouraging developers to say, hey, you got $100 in your pocket? Here, why don't you borrow $150? In other words, they were borrowing more than the assets or equity they actually had. China then decided to U-turn on that in August of 2020, and what happened? Well, the developers that were way upside down on debt could no longer borrow new money to continue financing their operations, which meant certain real estate projects weren't getting completed. When those projects weren't getting completed, buyers weren't paying for the projects, because the projects aren't done, and the Ponzi started to unravel. Well, that doesn't bode too well for the Chinese economy. And so, of course, Chinese real estate is now down about 37% in just 2021 and 2022 combined. Not great. But what about Evergrande? Yes. So within about a year of the changing of the 3 red lines policy, Evergrande failed to make payments on hundreds of billions of dollars in debt, dollar-denominated debt. Those losses exceeded $66 billion in 2021 and $14 billion in 2022. And so they basically said, hey, can we renegotiate? And we'll file for bankruptcy and we'll renegotiate. And those renegotiations or negotiations have been going on, quite frankly, for the last 19 months. It's gotten so bad that the founder of Evergrande was arrested. Well, now what happened and the news that was breaking in the last 24 hours here is that a court in Hong Kong has decided, you know what? These negotiations have gone on for too long. We are going to authorize a company called Alvarez and Marcel to liquidate Evergrande's assets. These assets could include the office building that they bought in 2015 for $1.6 billion. The problem, though, this is just Hong Kong. See, the majority of Evergrande's assets are not actually in Hong Kong. They are in mainland China. So the impact of this Hong Kong ruling isn't actually as substantial as it seems like it may be. We see headlines of Evergrande in liquidation. Uh-oh, that sounds really scary. But it gets actually scary when that liquidation is accepted by mainland China, which we're not sure if it will be. However, it may be. And if it is, then we're probably going to see additional property collapses in China. Trust in developers has already been shattered. This could affect consumption in China for an entire generation, affecting, we already know population growth is starting to trend negative in China, but the reality is people's net worth has now been substantially hamstrung, and future investment into real estate and trust in the Chinese economy may be significantly restrained given this sort of rugging by the Chinese Communist Party with limited effect from their policy support for propping real estate back up. Now, we did have slight upticks in real estate sales in Beijing and Shanghai in January, but most of China is expected to continue to see sharp real estate sales declines, and Bloomberg Intelligence thinks we need to see supply come a lot further down before we actually balance supply and demand. In other words, supply doesn't come down, prices just keep coming down. a liquidation of Evergrande's assets in mainland China could just exacerbate these issues. Now, the free market would say, sucks for Evergrande, let them fail. They took on too much debt, the rules changed, sucks for them. They hold the bag, take the properties, basically. That's what liquidation is. Take the properties, dump them for pennies on the dollar, and let the market solve the problem. That is the capitalist approach, but it's also one that could lead to a lot more pain in China. Now, why would we care? Why would we care in America? I mean, we could speculate on China by maybe investing in a stock like Alibaba, which trades for, say, a 1 peg, but that's only as good as the expectations for growth are. If the expectations for growth are wrong because the Chinese consumer is destroyed, then maybe you don't want to speculate on Baba or the Chinese technology, ETF K-Web. Maybe you don't want to speculate on those things. On the flip side, there's the potential that, hey, maybe liquidation will be orderly and it's good to get other people owning these Evergrande assets and get rid of that company and start over. But if Evergrande ends up dragging China into recession, it is entirely possible, if not entirely likely, that the entire global economy will fall into recession. After all, Germany's already in recession. China goes into recession because of this collapsing property market. Frankly, I think it probably already is, but an official recession, they're still officially growing at 5%, as much as we can believe that. But yes, it is possible that pain in China could shell shock the rest of the world. So pay attention to this liquidation in Hong Kong. Is the Hong Kong liquidation as big of a deal? Not really. What we really want to know is if mainland China will adopt the Hong Kong liquidation, and then Evergrande will finally be fully dumped. Anyway, thanks for watching. We'll see you in the next one. Goodbye.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.
Even though I'm a licensed financial advisor, real estate broker, and becoming a stockbroker, this video is neither personalized financial advice nor real estate advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show should not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purpose of evaluating a security or investment decision. Any links or promoted products are either paid affiliations or products or services which we may benefit from. I personally operate an actively managed ETF and hold long positions in various securities, potentially including those mentioned in this video. However, I have no relationship to any issuers other than HouseHack, nor am I presently acting as a market maker.